Okay, now welcome to the second session. So, the last day we talked much about draw on equity. We talked much about key levels, what you need before you take a trade. Should be, it's a simple question. You have to ask yourself, where is the next draw on liquidity? That's your first question you have to ask yourself. If you can see draw on liquidity, then you can see a clean setup, you can go risk on. If you can, whatever you see, if you feel like you are not confident in what you're going to do or what you see, you have to stay risk off. That is the key. So for example, I will give you a simple example. I saw a setup here today. We are in this balance. This is a key level, but on a daily time frame, of course, we are pushing down with clear ranges. Remember, in balance, and a balanced market comes back to seek for balance. Sellers are stronger. Market will come back to solve the problem. Then it goes down. Sellers are stronger. Market is trying to come back to solve the problem. So once we are here, you have to think like this. This is uh, your current anticipation that you must have in front of you. So of course, I knew a possible pullback is coming. Why? Because on a daily, if you look at this chart, I think I'm recording. I'm recording, brother. I'm recording. The recording is running. I'm recording, Mr. I mean, Miss Amen. I'm recording. So draw on liquidity is made on, remember, every time frame is independent. However, they are connected to each other. One does its own job and they submit it to another. Daily time frame will do something, and then the result will manifest itself on weekly, then weekly, monthly. So we know on her time frame, we are on a weekly, we are trading within a key level, which is this imbalance. You don't know when the market will do what, will make a return. So this is where we come up with the idea of what we call consecutive. How do we consecutive? Yeah, this one. Consecutive time frame alignment. So consecutive time frame alignment, it's the idea of doing analysis from one time frame to another. For example, if you are from monthly, you go immediately to weekly. If you are from weekly, you go immediately to daily. That is for, you do it when you are working on a structured time frame. But for entry and confirmation, we use what we call market maker time frame alignment. So you have to understand that the difference between that. So if I say consecutive time frame analysis, this is weekly. I will, before, remember, if I'm on weekly and I want to confirm a buy, I will move from weekly to 4 hour as a market maker time frame to look for what? To look for a change in a state of drift, or a break of structure, or what you call, what do you call that? Change of character. I don't know that. I saw you people talking about that. I have no idea, but I feel it's also the same concept. To see a break of structure, on a 4 hour, only if I have hit a key level on a weekly. Now, so if you want to continue selling, you use, first of all, you use what we call consecutive time frame alignment. So what you do, you don't jump any time frame. If you are in the weekly, you go to daily. If you are in the daily, you go to 4 hour. If you're 4 hour, you go to 1 hour. If you're 1 hour, you go to 40 minutes, 15 minutes. Just every time frame. You don't skip any time frame. It's what we call consecutive and time frame alignment. So you have to always remember that when you're trading. So for example, you want to take a trade today. Instead of jumping to 4 hour to look for a break or structure, know what you do, you go to daily. Just to keep looking at how market is using what structure time frame to keep the move, to keep the flow. So here you see you have got a drawn liquidity is taken, external range liquidity is taken right here. Now, market is looking for internal range liquidity. We know market will go back to look for internal range liquidity. Then another push. Sellers are stronger. Market need to go back to find the balance. Now, we have this level. Then here you see that you don't have what? We don't have any, and what? We don't have any imbalance. However, we have a key level, which is this other block we have here. So you mark out to see what. If you cannot see that, anything like imbalance, you can even look left to see if there is imbalance that is in line with that zone. And you can mark that. And you can mark that. For example, here, you may decide to mark this one. Inversion. Inversion fair value. Then you see if it is in line with what? With your zone. Because these are the true support and resistance. This is why you see market was reacting here. Right? Imbalances are true support and resistance. So you have to know that. Then, you have a key level here. The manipulation is forming on the daily. So if we are to go down here, if you are going to sell here, what do you expect? We are bullish here based on manipulation. Until TFU was formed here, we are bullish. If we want to go down, this manipulation must be negated. So you will wait for a candle to trade higher above this candle, and probably even about this one, because based on manipulation, this is supposed to be drawn liquidity based on the candle to candle manipulation. Remember, I told you if a candle is manipulated to the downside, the high is going to be liquidity. If it is manipulated to the upside, the low is going to be the liquidity. However, it may even react to 50% of it, they still decide to go down. So you have to have anticipatory skills. So if price here and you think price or of course it's not about thinking, we see that price is likely to continue to go down, so you have to expect the manipulation to form. It may trade higher but end up rejecting, for example, forming something like this. This is a bear candle. It forms something like this. Why do you expect that manipulation? Because we are bearish and we are hitting we are bearish, but on this time frame daily, on the high time frame weekly, we are bearish. Then the flow on the daily is still bearish. So you have to know if a candle trades higher, high chance is going to give you a negation because it's going to hit the key level, which is this other block, then start pushing down, and you may end up seeing a pattern like this. You may end up seeing a chart that looks like this, for example. See that? Hope you can see that. So this is what we're trying to talk. So what matters now, you have to know where you are. So draw on liquidity was taken on the daily, which is this external range liquidity on the daily. External range liquidity. When the daily was taken, external range liquidity was taken, we need to see a pullback. We need to see a pullback to look for internal range liquidity or to look for what? A key level. We still have imbalance. You need to see this one. We still have imbalance here. It can be tested multiple times. Can be tested multiple times. Now, so price may decide to come back here, trade higher, then it goes down. So you keep thinking that way. Do not force the market until on weekly, if you see manipulation forming here on weekly against this one. This is a sell manipulation. So we need another buy manipulation to form to confirm that we are no longer interested in going down on weekly, we are going higher. That's how you do analysis. So understand that consecutive time frame alignment, you do it just to see what every time frame is doing, especially when you are in a zone like this or when you are following the true trend market has created. But for entry, if you are on this time frame to confirm entry, you need to use 1 hour because we move from daily to 1 hour market maker time frame. That's what I showed you last day here. Price trading this zone, then you go to 1 hour and you see you confirm a break of structure right here. Then we know price is gonna create a pullback, then we go down. So same here. You are what? You are external range liquidity was taken here. Manipulation is being formed. The chart is still running. So what happens if you want to come back here? So we are on a daily time frame. We are on a daily time frame. If the daily key level was met around here. The key level was met around here, which is balance. Now, since we are here, you go to 1 hour. If you want to confirm a buy, go to 1 hour. And you find what? Find the break of structure. Find what? Find a break of structure. See that? Find the break of structure. Now after finding this break of structure, what do you expect? So if a new day start, for example, on Monday, if we start a new day on Monday, like here, and then you see Asian session range is forming, and you see manipulation is forming on your key level, which is this other block you have here. And of course, you have other imbalances here. Then price hitting your key level during a key time. We'll talk about session, not today. We talk about session, but what you see is happening during your key time. For example, if it is London, around 2, London session, 2 a.m. to 2:05 a.m. key time right here. Remember, when we are talking about trading, we start from time then price because time is better than price. Time is better than price. If you are trading, train yourself to trade time before you trade the price. Meaning, train yourself to mark your key zones like this. No matter what the market is doing, wait for it during your key zone. If you see manipulation is formed here, then you see another block is forming, then you buy, targeting what? Targeting that zone. And then at the end, if you look at the chart, you will see that it is a normal what? It is a normal range that was formed. Because you have a high, a low, a high, a low. Hope you can see that. Proper mitigation, market will decide to take this high. Then falls down. Hope you understand that. This is how you combine time frames and all of these ideas we are talking about to frame your what? To frame your setup. To frame your setup. So here, when we're working on the daily time frame, we work primarily on 4 hour manipulation. So pay attention here carefully because you are entering important section, which is about how to make entry. I'm just giving you a hint because uh, next session is we dive deep into time and the price. So this is the year candle. I show this is a bullish candle. I mean a bearish candle. This is a bearish candle. I have always emphasized that use what? Use 4 hour. 4 hour time frame is the most important time frame you need if you are intraday or or whoever you are. Because at the end, whether you are a swing trader or what, you need to study the candle so that you can make a good entry. So this candle, we say this candle has what? 24 hours. So we have what we call God. So let me use the real chart because I want to count it for our candles for you. Assuming this is the candle you are going to trade. We're going to trade this one. Okay, let me put vertical lines in this, even these candles. Okay. Now, I want to show you how to frame your entry setup. So every vertical line marks the beginning of the day. Marks the beginning of the day. So if you can count, we have a 4 hour candle that start. You can look on the bottom. Look on the bottom around here. You will see that black color you see Tuesday, May, 6th of May, Tuesday. Then you have 17 candle. We have 21 candle. We have 1 a.m. candle. We have 5 a.m. candle. We have 9 a.m. candle. We have 13 p.m. candle. And it's over. So how many candles? 1, 2, 3, 4, 5, and 6. Basically, this is the opening candle, which is also the closing candle. Basically, you have 1, 2, 3, 4, 5, because it will start from the middle. So you have to understand that. It will start from the middle. So 1, 2, 3, 4, 5, 6. So you have to understand 6. So now, these candles, what do? You must trade. You must. I say you must. Your entry must be based on a 1 a.m. candle. Remember, you're talking about 4 hour candles. If you are not timing candles, it will be hard for you. 1 a.m. candle, which happens during London session. It happens because it extends from 1 a.m., 2 a.m., 3 a.m., 4 a.m. to 5 a.m. and it ends. And remember, Asian random session start at 2, from 2 to 5 p.m. 5 a.m. So I can read that because when we talk about London session, London session entry, London session, 2 a.m. up to 5 a.m. New York time. from 2 a.m. up to 5 a.m. New York time. So in your trading view, you must have, look at my trading view here, you must have UTC -4 or minus, just depending on where you are, put your clock at New York. Click here and look for New York and choose there. Tick New York. Then we'll be able to see the same session. Like we already have the same session. Now here, you must trade 1 a.m. candle start at a.m. and ends around here. It is the one that happens during London session. However, it is started during Frankfurt session, which is start at the 1 a.m. Frankfurt session happens between 1 a.m. to 2 a.m. Then from 2 a.m. London session start and it ends at 5 a.m. New York time. So if you come here, this is 17 when the new candle start. This is 21. This is 1 a.m. This candle, your trade must start from this candle. It doesn't mean it's the one that will create the move. I mean, it's the one I'm showing you the candles you must be looking for. 1 a.m. candle, then 5 a.m. candle. 5 a.m. candle is the one that reaches at 9 a.m. Hope you understand. Then you move on. So this one extends all the way to New York session. New York session. This one up to here. New York session. Because there is New York kill zone. That start at 7 all the way to 10. Hope you remember. So what I'm trying to show you, 1 a.m., 5 a.m., 9 a.m. Not necessarily this one. We basically, when I miss 1 a.m., if I don't see a setup during this time, most of the time I run away. That means I identify an opportunity in that time. Now, what you do now, you have this bearish candle around here. You are going to sell this candle. Assume you know that you are bullish on a time frame. Assume that you are trading within your key level. So you have to trust that it will be bearish only because you know you are within your key level. I can only sell here because I know I'm within my key level, which is what? Yeah, on a daily, on a on a 1 hour time frame. I have got the break of structure using market maker. I know this is the last candle at least I have. So this is the key level. This is the key level. So I know this candle is likely to go down. This day is likely to be a bearish day because it will not break the key level. So you have to have that mindset. You have to have the narrative. You have to know what is going on before you believe. So what makes you believe a candle is going to be bearish? It's going to be bearish because it has hit a bearish key level. So you have to understand. Now, here, what you do, you will have, what? You will have open price here. During this open price, we are going to have a candle forming, 17 candle. 17 candle will form. Assume it's a bullish candle. Then remember, it is bullish because it is coming from, it is going to test this high before to make a reversal. And after this one, there will be 21 candle. Also, it will form around here, for example. See that? It will form around here. Assume this is the first 8 hours. So we are within the key level. We are working on this candle. This candle is going to be bearish. This is daily. I'm showing you on 4 hour. This is daily. This is the time frame. Then we have this one is 4 hour. This is the 4 hour. Now, remember, this is 21 candle, 9 p.m. Right? Then we are going to have 1 a.m. candle, which matches random session. Another candle that is going to start here, another 4 hour candle that is going to start here is your follows within your random session. It's going to start here. It will go up to manipulate, and then it will go down. So what do you do? What you do, you will mark this the high of this candle, because that's your manipulation. What you call turtle soup will happen, right? Now mark that the candle is going to start from here. It will start bullish and will trade here. So once it is here, once it has broken this high, you know you are within your key level. The candle has broken this high. It is trading like this, right? Immediately switch to 15-minute time frame. Because what is going to happen? This candle will start reversing. You will see it forming, reversing slowly, leaving a wick above here. Leaving a wick above here, and they start trading lower as bearish candle. They start turning bearish, right? Just manipulation is forming until the FU is forming on 4 hour. So one way, which is risky, immediately is to look for sales around here above. When it is trading higher, you start looking for sale opportunities. How do you confirm that? You use what? Remember, when we are on 4 hour and you want to use market maker time frame alignment, we switch to M15. So here you will have M15 time frame. You have a 15-minute time frame around here. 15-minute time frame around here. So here, what you do on 15 minutes, remember, on this high, when the high is taken, because we need manipulation. So on a 15 minute, remember, on a daily, we use the 4 hour manipulation to find the entry. So we are working on the manipulation. On a 15 minute, there are two things you can use. First and the safest model, and the safest entry model. It's BOS, break structure, and the retest of OB, other block, that will be formed on 15 minute, and the retest of 15-minute OB. (15-minute order block). This is the first and the safest entry model. The second one, however, even if this is the safest and the secure, sometimes you miss a trade because sometimes the market will break and will never come back. Immediately it continues to fall down. So you have to know that. Second, that less safest entry model, M15, 15-minute engulfing candle. So master this entry technique that you need here. So for example, here we're using the first one. Use the first one, you will have here as the market is pushing higher, it will create a certain structure. It will create a certain structure on the 15-minute. And once it hits the zone, it trades lower, breaking the structure. Here, but also it will create what? 15-minute order block. For example, it will create something like this. This is a bullish candle. This is a bullish candle. Now, here, to create another bearish candle, just engulfing a candle, right? A bear candle like this. You have 1 minute left. If you see the Zoom call disappear, go back to the group. I will send the link again because I no longer want to lose the recording. That's why I decided to use Zoom. So this is engulfing candle, but it has also created a break of structure. So this is the safest model. The safest model is to wait for a pullback to come back to test this other block or a fair value gap around this area. You understand that? Then you join, put your stop loss above this area. This is one entry model that you use. So I think I have less than 30 seconds left, I think.